Welcome to PIMCO Pod. In this episode, we explore how balanced risks to inflation and employment indicate it's time for the Fed to normalize interest rates, enhancing a positive backdrop for bonds. Stay tuned after the conclusion of the podcast for additional important information. Cuts and Consequences by Mark P. Seidner and Pramal Dhawan. Just as it marks the transition from summer to fall, September has often been a transitional month for monetary policy and financial markets. In September 1998, the Federal Reserve initiated an interest rate cutting cycle and a bailout of long-term capital management in the wake of financial crises in Asia and Russia. In September 2007, the Fed began cutting rates at the dawn of what would become the global financial crisis. A year later, Lehman Brothers' bankruptcy on 15th of September 2008 marked a peak in that crisis. The authors of this column witnessed the after-effects of Lehman's collapse firsthand in Midtown Manhattan and London's Canary Wharf, respectively. Many investors can recall exactly where they were at such significant moments. The Fed's policy meeting on 18th of September this year could be no less consequential. That's when the Fed is set to cut rates after the sharpest hiking cycle in decades to tame the post-pandemic inflation spike. This time, instead of fighting an incipient crisis, the easing may signal a return to normalcy as inflation appears to stabilize. Because Fed easing cycles are never alike, we'll examine the current situation, some patterns in past cycles, and what this could mean for investors. It's time to cut. For over a year, the Fed has maintained its policy rate at 5.25% to 5.5%, the highest since 2001 and up from near zero in early 2022. Despite these restrictive rates, the U.S. economy has remained resilient, while equity markets have hit new highs. Headline U.S. inflation, which peaked at about 9% in 2022, has receded to 2-point-something% levels, within reach of the Fed's 2% target. With inflation on track to return sustainably to target, the focus shifts to employment, the other half of the Fed's dual mandate, and the need for precautionary rate cuts to address a cooling labor market. While inflation risks have diminished, labor market risks are rising, as seen in recent employment data. When these risks are balanced, policy rates should be at neutral rather than restrictive levels. The Fed's latest projections from June estimate the neutral rate to be more than 2 percentage points below the current policy rate. At this point, we believe there's no reason to delay normalizing rates. We continue to expect the Fed to cut 3 times this year by a total of 75 basis points in our baseline view. Similar to how the Fed began its tightening cycle, we believe it will likely start easing slowly and maintain optionally to increase the pace of rate cuts depending on incoming economic data. Rate cuts and asset performance. Historically, market performance has varied depending on whether rate cuts are initiated amid material economic weakness, a hard landing scenario, or more moderate conditions, a soft landing. Some examples: intermediate and longer-term bonds have performed well, especially in hard landings. Cash rates are likely to come down as the Fed lowers its short-term policy rate. Bonds of intermediate and longer duration can benefit from price appreciation and historically have tended to perform well during cutting cycles, particularly if the economy weakens. Curve steepener trades have performed well, particularly in hard landings. Positioning for a normalization of the U.S. yield curve, which has recently re-steepened after its longest sustained inversion on record, could benefit most if the Fed cuts short-term rates significantly to combat economic weakness. The dollar has tended to decline, at least temporarily. In past easing cycles, comprising both hard and soft landings, the U.S. dollar on average has tended to fall, but then recover in the months following initial cuts. We see the possibility of the dollar losing its status as a high-yielding currency as policy normalizes, with potential for moderate dollar depreciation. Prepare for landing. A hard landing is typically preceded by increasing unemployment, larger declines in manufacturing and services, negative equity returns, and tight or tightening financial conditions. In contrast, a soft landing is often preceded by little change in unemployment, positive equity returns, and loose or loosening financial conditions. The current economic environment suggests a soft landing. Equity returns have been positive and financial conditions appear to be loosening. Unemployment remains low compared with previous cutting cycles, despite modest softening. Markets are currently pricing the terminal Fed policy rate at about 3% to 3.25%, That's consistent with a soft landing and seems to assign little probability to a harder landing. We'll also learn more about the Fed's expectations for U.S. growth when it releases new economic projections at the September meeting. Bonds can benefit from soft landings while offering low-cost hedging potential against hard landing scenarios. Bonds' traditional hedging and diversification properties were most recently on display in early August and again in early September, when fixed income rallied during periods of stock market volatility. Investors may look back at September 2024 as an opportune time to add fixed income exposure to portfolios for the diversification benefits as well as the return potential. While yields have declined from peak levels, we believe they remain attractive in both nominal and inflation-adjusted terms, and that the bond rally has more room to run as the Fed starts cutting rates. Thank you for listening. That was Cuts and Consequences. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcast may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.